how do you store money for 50 years, right? And the metaphor I give you as an aeronautical engineer, which I think Elon would like, and I think you'll like, is it's the difference between you launch something and it goes ballistic and comes back to Earth.
Suborbital versus orbital.
And you launch it and it reaches escape velocity and it goes orbital. One is in space forever, and the other's in space for a blink of an eye. And what we're trying to do is put energy in cyberspace, or put money in cyberspace, reach escape velocity such that it lasts forever with zero friction. It's like superconducting.
Wait a minute, everyone. Welcome to Bitcoin Zella, your platform for daily cryptocurrency analysis and news. Our mission is to keep it simple. Bitcoin Zella offers engaging information that is easy to understand. Our analysts keep their eyes on the latest news to provide valuable insights via email. Don't miss out on this opportunity. Join our community of 10,000 subscribers and experience the new edge with Bitcoin Zella. Subscribe now. In today's video, Michael Saylor is the co-founder, former CEO, and executive chairman of MicroStrategy, a company that provides business intelligence, mobile software, and cloud-based services. MicroStrategy is the world's biggest publicly traded corporate owner of Bitcoin, with 214,246 BTC. Michael discusses why Bitcoin will never fail, how to invest in Bitcoin, and the future of cryptocurrencies. So without wasting any time, let's dive into the video.
You know, I think 2020 to 2024 was, high volatility, high uncertainty. It's like that early stage of institutional adoption, but really we start mainstream institutional adoption. I would date it to January 2024 with the approval of the ETFs, the spot ETFs. And I think it runs, we have about a 10-year gold rush. It runs to 2034 November. Between 2024 and 2034, we will have mined 99% of all the Bitcoin. So Bitcoin becomes, for all practical purposes, fixed by November of 2024. The last 1% comes out over 100 years. Okay, so we have this 42-quarter period where at the beginning of the period...
What percentage are we at now?
Right now, we're like 94%.
Wow.
So you think it's not much, but I mean, 5% is a lot. That's over 10 years compared to 1% over 100 years. So there's actually still Bitcoin available for sale right now. The miners have to sell it. So at the beginning of this period in Q1, we're in Q1 now. If you go to January 1st, no institution could buy it even if they wanted to. It just wasn't on their radar. And so you really have 42 quarters of people learning what it is, studying it. It takes 10 hours to scratch the surface, and it takes 100 hours before you get a degree of comfort. Most people, once they get past the age of 40, they don't want to spend 100 hours learning a new thing. It's very rare. So you've got Wall Street firms spinning up massive education apparatus. You've got a whole set of stages of adoption. First, can I buy it? Then is it on the approved list for solicited sale? Then it is on the approved list for unsolicited sale. Is it marginable? Can I borrow against it? Is it optionable? Can I hedge it? Is it recommended? Is it structural? Is it built into a fund? That's like 7 layers of adoption. People take a year to think about each of those layers. There's 100 powerful entities that control huge amounts of money that'll go through that in the Western world. So I think we're in this institutional education stage. And in 2034, it'll simply be the new thing. Right now, it's like the scary, exotic thing for most people.
As the world gets into a frenzy around the coming Bitcoin halving and the price of Bitcoin, BTC, as a result, it's important to take a moment for a reality check. The halving is a non-event for the vast majority of the world. At its core, it's a simple evolution in how much the people who process Bitcoin transactions get paid. All electronic payments, whether made via credit card, Venmo, or the tap of a phone, require some kind of processing. Bitcoin transactions are no exception. On-chain Bitcoin transactions are processed by the vast network of so-called miners, who validate and record transactions on the blockchain. To date, these miners receive two types of rewards: a block reward, paid by the Bitcoin network, and a network transaction fee, also paid in Bitcoin by the person making the transaction. The coming halving reduces the first reward by half. There's nothing surprising in this. Rather, the halving is a predetermined part of the system, designed to regulate the supply of new Bitcoins in a predictable manner until the maximum of 21 million Bitcoins have been issued. Sometime in the next century, given current trends, the block reward for processing Bitcoin payments will halve until it goes towards zero. But the result of the decrease in the block reward has a substantial impact on the network transaction fee. The increase in transaction fees is a stark reminder that the supply of Bitcoin is, by design, limited. Once 21 million Bitcoins have been issued as block rewards, there's no way for anyone to create more Bitcoins or alter the supply, as governments often do with their own fiat currencies. This is why some people liken Bitcoin to digital gold. It's not a bad comparison, but there are two important differences to remember. First, the supply of Bitcoin is fixed at 21 million Bitcoins. The supply of gold is finite, but it's not fixed and known. After all, who knows what vast gold reserves might be discovered tomorrow?
The profound idea is every company in the world has toxic assets on its balance sheet. They're all liabilities, right? And we've taught the conventional wisdom in corporate finance is if you have capital, give it back and dividend it out. Facebook is buying back 50 billion of their stock and dividending out billions of their stock. Apple is buying back their stock and dividending out their stock. Scratch your head and think about this a second. I'm going to apply this to Harvard and MIT. Give back the endowment and just raise the cost of the tuition 20% a year and stack twice as many students per class, and that's how you fix the university. Right? No, right? How about this as an idea for your family? I want you to take all the money your family has, I want you to give it away to charity, and I just want you to tell your wife, your husband, your kids just to work harder and ask for a 15% raise next year. And that's how you're going to fix your family. I said, they're both pretty silly, right? And like, you would never in a million years have that as your strategy. We give up all the capital, we work harder. But you know what the corporate playbook is? Give up all the capital, raise your prices, work harder, grow your cash flows by 15% a year, and then you'll be fine. And that's why 99% of the companies fail. That's why the life expectancy of a corporation is 10 years. And you know what? I mean, Harvard, Oxford, Yale, they lasted more than 10 years. Did they do it by raising their prices 10% a year and working harder? No. In fact, there's not much productivity boost in any of those places in 500 years. So here's the profound idea, which is, if we adopted a different financial model in corporations, you could have companies last for hundreds of years. You don't have to die, right? For example, you're a dentist. Why do I have to raise my prices 10 or 20% a year to be viewed as successful as a dentist, right? It's because, I'll tell you why, because we keep expanding the currency supply by 10%, which means the price of everything you want to buy goes up by 10%, which means you have to grow your cash flows by 10%. And that's why the Magnificent Seven generate all the returns in the S&P 500, and there are 493 companies that return nothing. Zero.
Bitcoin is infinitely divisible. As Bitcoin gets more valuable, people will transact subdivisions of value. For example, there are 100 million satoshis in one Bitcoin. Gold is physical, and you can't subdivide it infinitely as it gets more valuable, though new digital gold entrants are attempting to make gold act more like, Bitcoin. The halving reminds people that the supply of Bitcoin is truly limited, and that demand is increasing, driving up the price of Bitcoin in the long term. As something becomes more valuable, more people will want to use it, and so the cycle continues. In the near term, the largest everyday impact of the halving will be a broader consumer shift to processors with lower cost transaction fees. Enter the Lightning Network, a second-layer network that Bitcoin transactions outside of the main blockchain. The Lightning Network processes peer-to-peer Bitcoin transactions almost instantaneously, just like on the main blockchain. The difference? The Lightning Network's transaction fee is just a few cents. For regular people, those making small transfers or using a bit of Bitcoin to purchase goods and services, this will become the preferred mode of transacting. It's fast and it's cheap. The relative ease of transacting with the Lightning Network may also accelerate consumer adoption. And do not forget to subscribe to Bitcoin Zella. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you like the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.